Let's now have a look at shareholder wealth calculations, and these are really based around profit-making organisations and listed organisations actually particularly. So the first of these you need to be happy with is total shareholder return, and this is a percentage calculation. This is in total how much money have you generated for your shareholders. And look, it builds in those two things I was saying, the two ways of generating shareholder wealth. Firstly, how much dividend are you giving them? How much cash are they getting now? And then the capital gain on the top of the formula there is the increase in share price. And then we divide that by the share price at the start of the year and times by 100 to turn it into a percentage. Really important that you get the start of the year because we're seeing how much return has been made based on the investment that was made at the beginning of the year. Next, you need to understand what makes up a share price. And one way of calculating a share price is to take a company's PE ratio, its price earnings ratio, more on that in a second, and times it by the earnings per share. And if you just think of the basic maths of that, P divided by E times E gets you back to P, the share price. A little bit more on earnings per share, that's the amount of profits that the company has made that could be given to shareholders. That's profit after tax, by the way. That's the level that we pay out our return to shareholders, our dividend. And we divide it by the number of ordinary shares, not including preference shares. I just want to talk a little bit more about that PE ratio before we move on. PE ratio, price divided by earnings, which we will be covering in another recording in more detail, that shows market confidence. A high PE ratio means that someone is willing to pay a lot for that share, the share price, compared to the earnings of that share, how much it's making. If you're willing to pay a lot for something that's not making you very much, that means you're confident in its future. So think of the PE ratio as confidence. Let's now practice some of these calculations. So here's an example that we're going to use for our shareholder wealth calculation. So we're told that the share price of CIMA Co rose from $4 to $4.60 last year. And during that year, they paid a dividend of 24 cents per share. And we're asked what's the annual return to shareholders, the total shareholder return. Pause the recording here and have a go at the calculation yourself. Okay, here's that total shareholder return formula, where we take the dividend per share, add the capital gain per share, and divide it by the share price at the start of the year, times by 100 to turn it into a percentage. The dividend per share, we're given that in the question, that's 24 cents. And the capital gain, that's how much the share price went up, that's 60 cents. That's the difference between the $4 and the $4.60. And we divide it by the share price at the start of the year, which was $4, and we turn it into a percentage, which comes to 21%. Not a bad investment, that. 1 year, 21% return. Much better than cash, eh? We're now going to have a look at more of an analytical question, and this one's around earnings per share. So we're told here about two companies, Bella and Pete, that are in the same industry. They've got the same level of earnings, so the same profit after tax. But Bella has a higher PE ratio. Given this information, which of the following statements is true? Bella's shareholders are more exposed to risk. Bella has a lower share price. Bella has a higher market capitalization. Market capitalization is the value of all of the shares added together. And finally, Bella's got lower growth prospects. Pause the recording here and have a think about each of these yourself, and then we'll compare notes. Now, the first of these statements, Bella's shareholders are more exposed to risk. We're told that they're in the same industry, these two companies, Bella and Pete, so it's reasonable to expect that they face the same risk, isn't it, if they're in the same industry? So that's my starting point. But I am told that Bella's got a higher PE ratio. So that means that investors are willing to pay more for Bella's shares than they are for Pete's shares, meaning they're more confident in Bella, and therefore it's likely that Bella is a lower risk company because investors are more willing to put money there. So I don't think that sounds correct. Next, Bella has a lower share price. So if these two companies have got the same earnings, but Bella has a higher PE ratio, when we take out earnings and times it by the PE ratio to get to the share price, that will mean that Bella has a higher share price. So that's definitely not correct. Bella's shares are worth more in total. Bella has a higher market capitalization. Now that sounds correct, because when we take the earnings and times it by the PE ratio, it's going to come to a bigger number because Bella has a higher PE ratio. Bella has lower growth prospects. Now that doesn't sound right. If a company's got low growth prospects, investors are less likely to want to invest. And so Bella would have a lower PE ratio if that was correct. But because it's got a higher PE ratio, that really means it's got better growth prospects. So the answer here is the third one. Bella has a higher market capitalization. Its shares are worth more. If you went for the first option here, Bella's shareholders are more exposed to risk. There is an argument that you could get to that. The reason being that if your investors are paying more to buy Bella's shares because they've got a higher share price, but the earnings are the same as Pete, then you've invested more for the same earnings. You're more exposed to the risk of the company not growing. But that's not as good an explanation as the higher market capitalization of shares being worth more. So that is the best answer, the third one. The next best answer is the first one. Okay, that concludes this recording.